So next we have a wonderful masterclass. Everybody is waiting for it. And we have Mr. Matthew out here, Mr. Matthew White, CEO at Vara. I think digital asset is not just hype, it's a reality. And let's hear from the master and how digital asset landscape is continues to evolve and what will shape up in the future. Welcome, Mark.
Yeah, sure. Is this... Good afternoon, everyone. I'll wait for the slides. I had a really positive crypto presentation planned for today, and then I woke up this morning to see that the markets had decided to crash abysmally. So I'll try and keep it positive. I'll stick to the story. I think there's still a lot of positives in the future, but I think today is one of those. We'll put it down to just one of those days. So quick introduction on my part. My name's Matt White. I am the CEO of Dubai's virtual asset regulator, VARA. I've been a technologist for the last 21 years. I worked as a management consultant before joining VARA. I also helped to set up the organisation from scratch about 3 years ago. Quick disclaimer on my part. I'm going to try and give you my personal views. So any views that I do express are my own. They're not necessarily those of VARA or of the Dubai government. And also, nothing in this presentation, as I alluded to just a minute ago, should be construed as investment advice. So please don't take it as such. I'm going to start with one of my favourite quotes about the sector and the technology. Bitcoin is everything people don't understand about computers, combined with everything they don't understand about money. And this is actually, but it was by a comedian, a guy called John Oliver. And I think it frames my presentation really, really well today. I think crypto and the technology that's underlying it, the blockchain technology, remains one of the most misunderstood concepts in modern finance, even amongst professionals in banking and technology, including myself. The complexity of the sector, what it's trying to achieve, and its implications are often misjudged or underestimated. And I once came across the suggestion that in order to understand the sector, or Bitcoin in particular, you'd need degrees in technology, in economics, in politics, and in philosophy. And I think that's a notion that I really, really subscribe to. The future of this is very, very complex. And whilst I'm not going to get into the underlying nuts and bolts of that technology today, I do think it's useful to keep in mind as we go through the presentation. So I want to break it down. I want to focus on two major areas. One is kind of where we stand today. The second is where do we go from here. And I'll try to keep this to about 30 or 40 minutes, leave some time for questions at the end. And I'm going to sort of talk you through a bit of a story of 2024 and what I see beyond that as well. So look, as a quick sidebar, I'm going to use the terms crypto, virtual assets and digital assets interchangeably. Crypto is a bit more relatable to people, but I tend to use the term digital or virtual assets in day-to-day use, and it's deliberate because crypto kind of has this association with kind of speculation and trading, whereas virtual and digital assets is more about the technology. But I think given that crypto is a little bit more relatable, I'll use that as the term. And much of the analysis that I've done sort of focuses on 2024. We've now seen one full quarter of 2025. That's exhibited some very interesting characteristics. So I'll try and bridge that before we get into the sort of where we go from here. 2024 was undoubtedly a year of transformation and resilience for the crypto industry. You could argue that the prior 2 years, 22 and 23, were sort of existential in nature in many cases. There were a number of sort of high-profile frauds like the FTX. There were a number of high-profile enforcement investigations, and I think the macroeconomic conditions at that time really depressed the market and felt like it was existential. But I think it's fair to say that the industry sort of subsequently demonstrated that resilience and those significant strides in rebuilding trust and fostering innovation, and it sort of matured into a solid financial and technological ecosystem. And as we'll see, there's been significant growth and adoption and product market fit in some specific cases as well. So we'll start here. By the end of 2024, crypto industry, in terms of its market capitalization, had gained about 90% and stood about $3.5 trillion in size. Today, that stands at about $2.5 trillion, following some retrenchment in the last sort of quarter, but that's still some 60% higher than the start of 2024. So we've seen significant growth. But what's important here, and it will become important later, is that the dominance of Bitcoin as part of that industry is extremely high. So today it's actually higher than that. It says 61% here. It's actually about 63, 64% today. So the importance of Bitcoin within that is extremely significant. I've marked a number of significant catalysts on the chart as well. So we've got the completely incorrect US spot ETF launch at the beginning of 2025, which it should be at the beginning of 2024, so the slides are incorrect. But the most important one on here is actually the ETF launch, which happened at the beginning of 2024. And at that point, we saw the price of Bitcoin surge from about $40,000 to somewhere in the region of $75,000. And it sort of then found its way onto the balance sheets of some very, very significant asset managers in the United States and became a focal point for the election as well. What then happened, as sort of following the US election, was that we saw it reach another all-time high of over $100,000. And it was ultimately that I think was the foundation for this, what I'm going to talk about as institutional adoption, and sort of forced organizations to sort of understand and adopt and understand and adapt to Bitcoin as a technology. Where do I want to go from here? Apologies. That was followed by the tokenization of some financial products, which increased dramatically, and we saw stablecoins sort of have a massive growth at the end of 2024 as well. I want to dive a little bit deeper into institutions, and so the approval of that BTC, the Bitcoin ETF, was a big part of that. But what I think that's done is sort of legitimised the asset class and made it more accessible to institutions. So IBIT, which is the largest part of this, graph, was the first ever ETF to reach about $30 billion in assets under management. I think it did that in about 5 months. It now stands at about 50 billion, and it holds over 1 million Bitcoin in that ETF. The data's it is a little bit imperfect, but we've also seen that about 25% of spot BTC ETFs are now held by institutions, and that's something that we'll come back to later. But it's worth noting that corporates are also becoming more and more important buyers of this ETF. But all of that being said, institutional involvement in the sector has really gone beyond the ETFs. There we go, it's working now. Pretty much every major institution that I talk to at the moment, and by that I mean banks in particular, is now looking at a stablecoin strategy. So I think the next significant wave of adoption comes from stablecoins and payments, which explains the surge of interest. Many of these organizations are now seeing the potential benefits and opportunities coming from, say, custody or brokerage of the treasuries that underlie that, interest income from cash balances, and other business models that we're seeing as well. And I think that the one thing that underlines that the most for me is Stripe's acquisition of a company called Bridge back in October. So that at the time, and there has been a larger investment since then, but at the time that was the largest crypto investment that we'd seen. It was about $1.1 billion. And it just underscores the importance of stablecoins in this institutional business as we're going forwards. But it's not just institutions. While they seem to be sort of driving these new use cases, 2024 saw a sort of a wave of adoption from retail and small businesses as well. So I think this graph is probably the best example of that. So what we've seen is emerging markets like Sub-Saharan Africa, Latin America, Eastern Europe are sort of bypassing traditional banking systems and embracing stablecoins, mostly driven by limited banking infrastructure and increasing mobile penetration. And what this chart actually helps to illustrate is that you can't actually see you can see what it is. It's a percentage premium on stablecoins by market. And what you can see is that the premium for stablecoins is much higher in these emerging markets where that adoption is starting to take off. The next trend for 2024 I wanted to talk about was around fundraising. I won't spend too long on that, but essentially we saw fundraising recover a little bit in 2024, and that was up to about $2 billion in November in its own right. The major deals that happened in that month were a stake from Cantor Fitzgerald into Tether, which was about I think it was about 600 million, and also Marathon Digital's post-IPO debt issuance of about 850 million as well. So I think it's worth keeping an eye on this. I think as we go into 2025, we're going to see more fundraising deals. We've already seen Abu Dhabi invest in Binance, which was a $2 billion investment. Circle has filed for its IPO in the US. I think that's estimated to be about 5 billion in valuation. So I do think we'll see this trend continue. Okay. The other really important piece of information is that activity and adoption is increasing as well. So what we found, what I thought was a useful graph here, is that monthly active crypto addresses sort of resembles the early internet adoption and reached an all-time high in 2024. This is also supported by some analysis from Chainalysis as well, which talks about their global crypto index. And between the fourth quarter of 2023 and 2024, there was this huge kind of spike in the total value of crypto activity that happened, and that was actually much higher than the 2021 bull market that we saw as well. What's also notable is same report from Chainalysis that crypto activity increased across all countries, not just subsets of that. DeFi activity in particular increased in the lower income countries, in the emerging markets that I talked about earlier on. Okay, yeah, and this chart of the sort of total value locked in DeFi helps to illustrate that as well. It's grown steadily from the lows in 2023, and currently just stands just shy of 100 billion. But look, we can talk about the numbers of crypto addresses. It's hotly debated. People disagree on it. But I think there's two kind of anecdotal ones anecdotal examples that I'll give you just to illustrate the adoption. A particular wallet called Phantom Wallet. Those of you in the industry might use it. That was actually in the top 10 iOS apps at the back end of 2024, so it shows the kind of usage and the adoption of that. And the second one was Polymarket. I'm sure most of you have come across Polymarket by now, but Polymarket onboarded about 1 million users only in Q4 last year. So there's some anecdotal evidence to back up this kind of adoption of DeFi and the fact that it is accelerating as well. The last thing I want to highlight about the current state is sort of what happened in 2024 when it comes to regulation. There we go. Massive shift in global regulatory policy, frankly. It was a turning point for crypto policy as a whole, not just because of what happened at the end of the year. In Europe, we had MiCA that came into effect. It's now being implemented in phases. The aim of that for the European Union is essentially was to get ahead of other regions, sort of fostering that innovation within the EU. We've got the UAE, where the Middle East is concerned. That's been at the forefront of crypto regulations for some time. We've seen rapid growth there as a result. I've seen that personally. You've then, I think Chainalysis actually ranked the UAE as the 7th largest crypto market globally, which is quite substantial when you think about it. You've got other approaches in the Middle East. You've got Saudi and Qatar that are looking at kind of more digital asset tokenization initiatives, and some that are looking to ban that outright. And at the moment, I think the UAE is sort of firmly ahead when it comes to regulation. Asia remained very dynamic. Hong Kong introduced some crypto legislation for virtual asset trading platforms. It's now debating stablecoin legislation. Singapore has been very proactive. Japan has been very proactive. And so we expect to see Asia, or at least in 2024, we saw Asia, and we expect to see Asia grow and grow. We have Latin America, which, as I understand it, hosts 4 of the top 20 countries for adoption, according to, again, the same Chainalysis report. There isn't a suggestion of a unified regulatory framework in there at the moment, but it's likely to come at some stage. And then finally, we have this US regulatory clarity that came at the end of the year. Basically, huge recent shifts in the US. I think they're likely to drive global trends in 2025. What we saw in 2024 was a bit of an intense struggle with the SEC at the beginning with this regulation by enforcement. There was some lobbying and some pushback on that with some allies in Congress, and then obviously we moved into the era of it being a very pro crypto presidency, and that has shaped what I think will be 2025 for that. What's clear, I think, overall, is that global jurisdictions have woken up to the fact that this sector requires attention, and they did this in 2024, and this has driven a large amount of that activity as well. So we've got rapid growth and adoption, we've got product market fit, we've got fundraising picking up, and we've got regulation being a catalyst for where we ended 2024. So where does that leave us today? I mentioned that there's been a bit of a bridge between the end of 2024 and Q1. The most notable occurrence in that is the general market kind of trend and sentiment as a result of the economic activity in the US and the policies of the new administration. Clearly that's affected all markets, not just the crypto markets, but we've seen a nosedive in market cap. I actually don't think we've seen a nosedive in sentiment towards the crypto industry. If I look at what I'm seeing from Vara's perspective, our licensing pipeline's only going one way. More and more applicants are coming into that pipeline. We're seeing more and more institutions want to get involved in that as well. So I don't think that, I feel like the turmoil that we've seen in the last quarter will be fairly short-lived. I don't think it changes the fundamentals of what I wanted to talk about in the presentation today, but it's clear that there's been a pullback, which I think is to be expected. So where do we go from here? I've chosen 5 or 6 themes that I think will drive the short to medium term of the crypto industry. And many of these will have make or break moments in 2025. There are some other important themes that are not on here. I've chosen to leave them out. I think some others might disagree with that. But these are the ones I'm more certain about. And I think it's also worth pointing out that from a background perspective, I'm much more on the side of this technology driving evolution of financial infrastructure than I am on the side of the technology to create speculative trading opportunities for people. And that has certainly shaped the themes that I want to talk about this afternoon. The one thing I would say is the turmoil that I mentioned, I do think there is a possibility that has a headwind, it creates a headwind for the industry, but I don't think it has a long-term impact on these items, and I still think we'll see these play out, whether it's back end of 2025 or early 2026. I think we'll see this stuff happen. There we go. Apologies for that. So, look, number one, policy shifts are going to significantly influence the direction and the success of this market going forwards, without a doubt. US regulatory clarity and this pro-crypto stance is going to be the main driver of that. No doubt in my mind it'll be the driver globally, not just in the US. I think that's fairly obvious. What I found remarkable is that is how significant crypto advocates were during this recent election in 2024. I don't know whether somewhere in the region of 43% of crypto donations came from crypto corporates in that election. The prior election was not even not even 10% of that. So the amount of kind of interest from the crypto industry was huge, and that sort of resulted in about 60% of Congress seats being sort of pro-crypto in nature. And that really only does one thing, right? We've already seen the Trump administration make changes to key regulatory positions, more crypto-friendly people. The chairs of the SEC and CFTC are notable examples of that. But you've also got members of the cabinet that are now speaking out much more positively about crypto and about Bitcoin. We've also seen sort of anti-crypto laws and regulations get repealed. So SAB 121 is a good example of that. But we've also seen Senate hearings that are focused on anti-crypto stances around banking, for example. So something called Operation Choke Point 2 was recently debated. And then we've also got bipartisan legislation around things like stablecoins that's already been introduced. So no doubt that I'd expect to see some fairly substantial changes to regulatory policy in the US in 2025. And all of that is going to drive investment, it's going to drive adoption, and it's going to drive growth, not just in the US, but around the world as well. But it's not just the US that is poised to make regulatory changes. Guys, there we go. Lots of the G20 countries that I've spoken about already and the major financial hubs are writing rules to accommodate digital assets in response to this type of activity that we're seeing. This is the cryptocurrency value received by region last year. I've touched on some of it already, but I thought I'd give you a quick flavour from a personal perspective and from Vara's perspective of what we're doing specifically, to give some good examples. So, not sure whether you know very much about the virtual asset regulator in Dubai, but we were the first dedicated regulator for this space. And so we have quite a unique vantage point in terms of what's happening in the market and what's happening with the asset. Some of the things that we're looking at doing this year, we're creating this blueprint for digital finance regulation. So we aim to facilitate about $20 billion worth of virtual asset transactions by the end of the year through the exchanges and brokers that are coming into the market. We've decided to regulate by activity and on principles rather than by products, which gives us flexibility while maintaining that oversight. We're also looking very carefully at global partnerships and regulatory alignment. We're working with major hubs like Hong Kong and Japan in particular to establish bilateral relationships reflecting the fact that the technology is borderless. So there's a lot of work going on in that area. And then we've got certain market structure regulations as well that are reflecting sort of evolutions in the market. So we have new regulatory frameworks for custodians and market makers, and also tokenized finance, which is something I'll come on to later, is something that we're really, really focused on as well. And all of this kind of pro-regulation, these new rules, not just here but everywhere else, is going to, as I said, drive the future direction and growth of the industry, in my view. Sorry about this, guys. The slides are very slow. There we go. So the next kind of theme I wanted to talk about is around ETFs, and I'd frame it as the success of the Bitcoin and Ethereum ETFs are undoubtedly going to drive more action, right? In my view, these ETFs have fundamentally reshaped the market dynamics for Bitcoin in particular, and it's only going to continue with the introduction of things like options in that market, which will enable enhanced risk management and exposure, particularly for institutions as well. And we've actually seen a rapid uptick in filings for ETFs in the US, ranging from some of the more well-known assets like Ripple's XRP or Sol, right the way through to meme coins as well. Now, whether or not these get approved or not, I'm fairly skeptical about whether they will all get approved. But it is a sign of the direction that people are trying to go with this, particularly in the US. There's about 35 filings that are currently open, and depending on the health of the underlying spot markets, will probably drive whether they're going to get approved. I actually think, from my perspective, a more significant change in this area would be the SEC allowing in-kind redemptions as opposed to cash, and or staking of the assets that are in these ETFs, much more than the specific ETFs themselves. But whatever you think about ETFs, there is a bit of a mania around this at the moment. It is going to continue. There's something to watch out for because it's going to drive institutional capital, I think, into the market a little bit more. But I don't want to spend too much longer on it. The next sort of two or three are much more important in my view. And the first one of those is that Bitcoin will become a strategic asset for institutions, corporations, and governments. I'm not what you would call a Bitcoin maximalist, but I do have a firm belief that it's a higher quality digital asset than the others, and perhaps one of the only true use cases with product market fit. And I chose this first chart to illustrate a point, although unfortunately you might not be able to see it. This is the crypto market cap excluding Bitcoin and Ethereum, and actually Ethereum doesn't make a huge difference. The problem is the names have changed, but the numbers haven't. There really hasn't been any growth in that market over the last 5 years beyond Bitcoin. So despite this promise of innovation and endless new blockchains that are coming online, this Bitcoin dominance that I talked about earlier on is actually rising. It's not going down. And I think that signals, for me, that's one signal around the importance of this asset in the market. And I think, I don't think that's to say that in the future that there won't be these other killer use cases that come along, but I think at the moment there's a clear gap, and it's a foundation for why I think Bitcoin will become this strategic asset in 2025. I want to talk a little bit about the correlation now between Bitcoin and some of the major indices like NASDAQ. Here we go. Okay. So this correlation indicates that there is an interplay between Bitcoin as a store of value and its connection to risk assets. And many analysts view this Bitcoin, including myself, as a hedge against inflation and currency devaluation. I don't actually have the chart here, but one of the things I wanted to explain is that despite the fact that we've seen over the last 3 months the Bitcoin price drop significantly, what we're actually seeing is retail investors selling and institutional investors buying quite significantly. It's a really, really marked, there's a marked difference between the two. So I don't think price tells the whole story. What I think is happening is people really are seeing this as a much more protection asset. It's much more of a hedge to risk, much more of a hedge to inflation than we actually think. And this correlation will just helps to illustrate that point. I want to go back to the ETFs again briefly. What's important to note here is that, as I said, over 1 million Bitcoin are now held in those ETFs following those inflows. And whilst the first quarter has seen those sell-offs, as I said before, these institutions and corporate holdings are going up. And I think it's quite likely that institutions are going to become the primary drivers of daily price action over time. And more consistent spot inflows from these should also lead to sort of fewer leverage-driven moves as well, which will reduce volatility of the asset. And I'm going to skip through some of these slides. You get the point that I'm trying to make. I'm trying to skip through some of these slides. Okay. But I think this is an important table as well, just to illustrate my point. Companies and corporates are actually increasingly using this asset as a treasury asset with some yield-generating strategies. So, excluding the ETFs, and this number excludes the ETFs, Bitcoin held in corporate treasuries is about 1.5 million, which is roughly $128 billion worth of Bitcoin is actually held in corporate treasuries at the moment. And that number's actually gone up 2% in the last month, despite the turmoil. What we're seeing is that these traditional firms aren't just holding it, as an asset to appreciate. They're also going to use this as a strategy to enhance value by lending it out and using other derivative strategies as well. And so I really do expect a sort of robust accumulation to persist in 2025, especially as this regulatory clarity and political developments create a more stable framework for corporate investment. And the last point on this is, of course, the strategic Bitcoin reserve, which I couldn't get away without talking about the infamous strategic Bitcoin reserve. Most of you will know that in March we started talking about this as a sort of policy issue within the US, and quite recently, July I think we started talking about last year, is in March this year that the US administration announced the strategic Bitcoin reserve within the US. This is really only going to enhance buying from governments and from institutions and corporates, in my view. Governments already hold around 500,000 Bitcoin, I think. So about $60 billion US worth. I think 200,000 of that is in the US, another 200,000 is in China, 60,000 is in the UK. There's a whole bunch of governments that are looking at buying this at the moment. But as these sort of budget-neutral strategies for purchasing additional Bitcoin in the US come to fruition, I don't think we'll see that towards the end of the year. You are going to see big purchases in this asset as well, and it will only become more and more strategic as we go through it. So that's my Bitcoin pitch. That's my first major trend. The next one is around stablecoins, and I think stablecoin use cases are going to proliferate and disrupt banking and payments. Full stop. When you look at the divergence between stablecoin activity and crypto market cycles, what I think is clear is that adoption has moved beyond trading. We used to have this kind of idea that stablecoins were used really just to get in and out of trading positions and for use as collateral. But when you start seeing that addresses going up, and the previous chart that I showed you around premium of stablecoins in emerging markets, it's quite clear that adoption's moved beyond trading and is increasingly being used in payment systems and remittance systems on crypto rails, which is facilitating payments, streamlining cross-border transactions, giving easy access to dollars that people haven't had before. And these volumes are growing by about 50% year on year, which are sort of rapidly catching up the largest payment networks. This graph, in fact, is from Visa, not from a crypto provider. Visa are actually taking quite a hard look at this at the moment, given its importance. The other interesting statistic that I wanted to show you around stablecoins is that stablecoin issuers are collectively the 18th largest holder of US Treasuries, and also an important sort of net purchaser of US government debt in the process. So one of the things I thought was interesting is one of the former House speakers, Paul Ryan, has recently, quite recently argued that stablecoins might not only help preserve dollar dominance, but also help tackle the growing national debt problem. And I think we're starting to see the administration wake up to that in the US as well. It's not the be all and end all, but it's something to watch out for with the stated objectives and the recently introduced legislation in Congress, which is around stablecoins as well. Okay. So one of the things I thought was important around stablecoins was you'd be forgiven for thinking that the market was consolidating around one or two main providers, so namely sort of USDT, Tether, and USDC Circle. But having spoken to a lot of the traditional players in the market, banks and payment networks in particular, a lot of them see that the future, consists of a multitude of sort of smaller, interoperable stablecoins that are going to serve as the new architecture for money transfers across the world. And these incumbents, if you like, are working on a lot of ways to experiment with and embrace stablecoins in their current workflows, which have led to a number of prominent use cases. And the names that we're talking about here, the likes of Citi, JP Morgan, Standard Chartered, they're all experimenting with this. And I'll pick on just one or two. I don't want to spend too long talking about the use cases that many of you be aware of, but obviously we've got a payments and remittances one. It just makes absolute sense that a cheaper, faster, more efficient set of payment rails is going to revolutionise the infrastructure that we've got in banking. But one of the interesting ones that's coming out here as well is around decentralised finance. So I'm not sure if you're aware, but the yield that you can get on dollar-backed stablecoins now is about 2 or 3 times a traditional money market fund. And the reason for that is simply that there's a demand for stablecoins. There's a demand for this that doesn't exist in traditional markets. So there's a really interesting use case around decentralized finance that is worth keeping an eye on. We know about asset protection and inflation hedging. We know that people in emerging markets are looking to hold dollars as opposed to their native currencies to protect against inflation. And we're also seeing that from a settlement and clearing perspective, an interbank set of use cases, this is becoming more and more prominent as well. I think I was talking to someone at Citi recently. They said that the total settlements between Citi and JP Morgan was about $40 trillion a day, which is about I think either 20 or $40 trillion a day. It's about 40% of the global market around that, and they're looking at whether this could be made much more efficient just by having kind of this interbank stablecoin that could be used as well. So there's a huge amount of disruption that's coming in that, in my opinion, and it's no surprise that these use cases and that stablecoin issuance is becoming a part of the financial system is leading to regulatory scrutiny around the world. Quite clearly, without proper oversight, the risk to financial stability, the risk to consumer protection, the risk to integrity of financial markets are going up. And many jurisdictions, including the UAE, have also introduced regulations to govern stablecoins. Most of those centre on things like liquidity, reserves, and transparency, as well as AML. But I'd expect to see, we've already seen this introduced, but I'd expect to see this concluded quite quickly, is legislation in the US that governs US dollar-backed stablecoins. I expect this will get concluded in 2025. It's already gaining momentum. We have the Genius Act, we have the Stable Act, coming at it from different angles. It's bipartisan legislation, and I think we'll see that conclude in 2025. The one thing to watch out for here is there's a risk here as well. I think everybody's waking up to stablecoins as being this great cross-border technology. The problem is each type of regulation is slightly different, and that lack of homogeny could eventually cause problems if you've got a US dollar-backed stablecoin, but you can't actually use it anywhere else because that legislation in that jurisdiction isn't quite aligned. So there's a bit of a risk there, I think, that we're seeing at the moment. It's something that I'm keeping an eye on personally around that as well. Okay, next one, the tokenization of everything. Tokenization is going to revolutionize financial markets, period. Come on. What I mean by tokenization is the creation of a digital token that represents legal ownership of traditional real-world assets. They live on a blockchain, they're tradable online, but they don't have any of the cumbersome paperwork or waiting periods. And currently, there is about $20 billion worth of these assets on chain. It's mostly private credit at the moment, some US Treasury debt, but this has quadrupled in the last 4 years, and I think it was McKinsey's study that expects this to be about a $2 to $4 trillion market by 2030. But I'm going to talk a little bit about Larry Fink, because one of the strongest signals for me is the interest with which the largest asset managers, like BlackRock, like Franklin Templeton, are approaching the space. And I'm going to use a quote from Larry Fink's recent letter. There we go. Letter to shareholders, because I think it is absolutely spot on. I couldn't think of anything better to say, actually. So every stock, every bond, every fund, every asset can be tokenized. If they are, it will revolutionize investing. Markets won't need to close. Transactions that currently take days will clear in seconds. Billions of dollars currently immobilized by settlement delays could be reinvested immediately back into the economy, generating more growth. I think he's absolutely right about that. He also talks about tokenization making investing much more democratic, and I mean that in terms of access to investments, shareholder voting rights, yield. This is all stuff that I'm very, very passionate about. Assets that are currently unavailable to large numbers of potential investors will suddenly have these lower barriers to entry, and it will change everything. Assuming appropriate regulatory clarity this year, and we'll get some of that, we won't get all of it, but I think we'll get some of that, I'd expect a significant acceleration of this trend. The chart on the right, I'd encourage you to have a look at it. It's a McKinsey report, very good. Talks about 3 waves of tokenization, which will result. The waves themselves will result in sort of differences in expected benefits, whether they're feasible, how long it's going to take, who the buyers are, etc. I think it's sensible. I think 2 trillion is a sensible number, but when you consider that, I think total global assets is something like 250 trillion. 2 trillion doesn't really seem like a lot when you think about what I just said from BlackRock. So I think that's a conservative estimate of where we'll get to. I'll move through this very, very quickly. The one thing I've talked about quite a lot, also Larry Fink mentioned this in his letter, this can't be done without a unified global digital identity, which doesn't exist at the moment. So there is a technological barrier to this. We have some very, very strict requirements around identity. It's critical for issuers to be able to identify who a wallet owner is and whether they're eligible to own a particular asset, a particular security. And if we're really going to achieve the promise that I laid out before, this is a problem that's going to get solved, and we're going to need to balance privacy and compliance, interoperability, security, and also global inclusivity into an identity that actually works for this as well. And there are a whole bunch of other enabling factors that are required, but this is by far and away the main one. The last thing I wanted to mention is about the renaissance of DeFi. I deliberately haven't spoken very much about DeFi. It's a very nebulous topic, but conceptually, everything I've talked about is DeFi in some way, shape, or form. I think we'll see a continued growth in that total value locked that I said. I think we'll see a continued growth in volumes. It'll be driven by a few things. One is this consumer DeFi piece. As we get interest rates coming down, the yields from DeFi will be much, much more attractive to people, and they'll see this as something that they want to invest in. the tokenization point that I mentioned earlier on is, strictly speaking, decentralized finance, and therefore with the growth of tokenization, we'll see the growth of this total value locked in volumes as well. But also there's an interesting trend around platforms where DeFi is concerned. So we're moving from and I don't want to get into too much technological sort of jargon, but we're moving from an area where a DeFi was a protocol in its own right, a small component of that, right the way through to where they're kind of much more vertically integrated and they're providing ecosystems for people to build on. Stripe is a really good analogy of that, actually, how Stripe sort of took over the payments industry. DeFi is doing something similar. Uniswap version 4 is a good example of that if you want to go and look it up. So before I close, and I'm just looking at time, I've got no idea where I am for time. Before I close, I just want to touch on a few key risks to what I've talked about in terms of trend. One is global macroeconomic uncertainty. There's certainly going to be something to watch out for. You know, the markets at the moment, they're not decoupled. People would like them to be completely decoupled. They'd like to see Bitcoin as a complete hedge to what's going on in the financial markets. It's absolutely not at the moment. So global macroeconomic uncertainty is going to potentially have some headwinds in here, as is regulatory policy uncertainty and fragmentation. I think, as I've said, policy is going to accelerate. We're going to get increased clarity. We're going to get policy changes, but we're also going to get fragmentation with that. If I look at global jurisdictions at the moment, everyone's racing to put in place regulation. What that means is we're not all talking to each other about that at the moment. I think at the baseline level, those regulations are more or less compatible. I think at some of the outlier levels, they're not as compatible as they could be, particularly around things like DeFi and tokenization. So that in itself is a potential headwind for some of the trends I've talked about. And lastly, increasing cybersecurity threats. And the recent hack of Bybit, which I'm sure you'll have all come across, is a sort of wake-up call, and it underscores that no system is truly secure. Hackers are, and my background was cybersecurity actually prior to becoming a regulator. Hackers are very much in this kind of return on investment stage at the moment, where they're actively looking for the biggest kind of returns on the investment that they're making. So crypto is obviously going to be a target for that. If we see more and more of these attacks happening, it's quite likely that causes headwinds for the industry as well, as we start to deal with that. So that's where I think we go. And just to wrap up, I don't think this is a side conversation anymore. I think this is an integration into the global financial system. I'm very, very positive about where we get to. And thank you for listening.